بسم الله الرحمن الرحيم. My dear students, Assalamu alaikum wa rahmatullahi wa barakatuh. This is the last lecture regarding international accounting, and I hope that I can repeat it with you face to face in our class, inshallah. The sixth subject is called performance evaluation in multinational corporations. Performance evaluation may be for the MNC itself or for the manager of the MNC or the branch or the subsidiary of the MNC. Performance evaluation means assessment to assure that all our objectives met. Performance evaluation definition. This is a periodic review of operations or activities to assure that the objectives of the enterprise are being met or accomplished. A corporation's performance evaluation system is a part of its financial control system. So our financial control system includes performance evaluation. As I am planning, then making follow-up, then controlling the performance, evaluating the performance to be able to have enough information for decision making and decision taking. The MNCs must have an accounting information system to evaluate domestic operations as well as foreign operations. Now, financial measures used by MNCs to evaluate domestic and foreign subsidiaries or branches are just two. Number one, profits and return on investment. Number two, budgets. Regarding number one, profits and return on investment, one of the frequently reported tests of profitability is the relationship of profits to the entity's invested capital. Why we are saying that it is one of the frequently reported tests? Because I may compare profit by sales, profit by fixed assets, profit by total assets, and so on. So when comparing profits with invested capital or dividing profits on invested capital to get the ratio of profits to invested capital, profitability of invested capital, I can get profitability of sales, profitability of fixed assets, profitability of total assets, and so on. As discussed before regarding financial statement analysis, this relationship is expressed as ratio of ROI, return on investment. However, it is not the only measure of profitability, as I explained just now, and should be used only in conjunction with other performance measures. Maybe liquidity, quick liquidity, and others. Now, budgets, this is the second method used for performance evaluation. Budgets as a success indicator. To indicate my success, budgets is a good tool, a good method. Because when making budgets, I'm putting what should be regarding sales, regarding costs, regarding performance in general. So after putting these budgets, I can compare the actual results with the budgets to see if there is variance or there is no variance. The variance may be favorable, may not be favorable. I have to analyze it to take the corrective action or to take the action in general. One purpose of the budget is to clearly set out the objectives of the entity. Okay, a budget generally provides a forecast and a mean of comparing the actual results to get variances, if any, that should be analyzed, as I told you just now, for improving the efficiency of future operations. When a budget is used for a foreign subsidiary, it should be developed by that subsidiary itself. Why? Because each subsidiary knows well what about the subsidiary, what about the branch. But how I let them to put the budget, they may put it in their sake. No, there is, as we will see in the end, at the end of this slide, what is called intelligent empowerment, التمكين الذكي. This means that I let them put the budgets and I will ask them about this budget. At the same time, I'm considering the budget, how they put it. If there is something needs correction, I tell them to correct it. So, when a budget is used for a foreign subsidiary, it should be developed by the subsidiary itself. The experience of the local manager is extremely important to set his own performance standards, and it produces a very deep knowledge of the specific business situation with considering self-control with intelligent empowerment. So, what is called in Arabic الرقابة الذاتية والتمكين الذكي. تمكين ذكي يعني ايه؟ يعني أنا بمكن المدير من إنه يؤدي as he wants, taking into consideration self-control, and there is outside control, but without telling him. So, in international operations, top management is not as familiar with what the standards should be. That's why the subsidiary knows it more. Mother company uses each foreign subsidiary's budget to develop an overall company forecast. So I will consolidate all the subsidiaries' budgets to make up the whole budget of the MNC. Mother company analyses are based on a wide spectrum or chain of knowledge, including knowledge of possible environmental objectives and the strategies changes on the international level. Budgeted information is used more frequently to assess the individual subsidiaries' performances rather than the overall performance of the MNC. So the information that we can get from the budget, we can use more frequently to assess, to evaluate the performance of the individuals themselves before evaluating the MNC as a subsidiary. Non-financial measures used to evaluate the non-financial measures used to evaluate and enhance or improve MNC's performance. We saw and we dealt with all the financial or some of the financial measurements that we can use as return on investment, for example, and other profitability, as well as the budgets. All these are financial measures. Either non-financial measures can be used to evaluate or to improve performance. Yes. The most of these measures are quality of output. So, improving the quality of output and the satisfaction of the customer are very good non-financial measures to consider. Employee consent and research as well as development is other measures of non-financial measures that we can evaluate and improve performance through, because the consent of the employees means that they will perform well and the quality of output will be okay, so the customers will be satisfied, so sales will be increased, so profitability will be better than before. Also research and development to improve my operations, to improve my output, to improve all the circumstances around my operations and activities. New product development. I may develop some new products for competition and for the satisfaction of my customers. Market growth or success. So, as my market is growing, as there is success in my markets either internal or external markets. This means that more sales, more customer satisfaction, more profits, more profitability. Also, environmental competitiveness. That's to say, being able to compete environmentally. And this is some factors regarding competition in different environments. Issues to consider: developing MNC's evaluation systems. MNC's reports do not make a distinction between the evaluation of the manager and the subsidiary itself, but we have to assess the performance of the subsidiary as well as assessing or evaluating the performance of the manager of this subsidiary. Practices reveal that US MNCs report using the same financial measures to evaluate the performance of both the manager and the subsidiary itself, but I think there are different measures for the subsidiary and other measures for the manager himself. The most frequently used financial measures are profits and the profitability. This is number one. Profits, absolute figures: £100,000, $200,000, 500,000 sterling pound, and so on. Profitability means the profit divided by sales, divided by funds invested, divided by equity, divided by fixed assets, to get profitability of sales, of equity, of funds invested, of fixed assets, and so on. Budgets compared to actual performance is another financial measure. So if I have budgets, then I have actual performance. Comparing both will give me the result. If the actual performance is equal to what budgets indicate, or more than or less than, and if there is variances either variable, favorable or unfavorable, we have to analyze to be able to take the accurate and right actions. But Japanese MNCs use sales when evaluating subsidiary managers' performance. This means that myself, suppose that I am a manager, if sales of last year equal $2 million and this year became $3 million, so my effort resulted in increasing sales, and this is one of the indicators of my performance as a manager. Now, what is meant by responsibility reporting? These are reports considering the performance of the manager or the employees themselves. Responsibility accounting, or what is called in Arabic محاسبة المسؤولية, is a mean, is a tool, is a system for controlling performance and for evaluating performance. That's why responsibility reporting as an accounting system traces costs, revenues, assets, and liabilities to the individual manager who is responsible for them. It follows that a manager who has the ability to control the results of operations should be evaluated on the basis of the results over which he has a control. As I am able to control something, so I'm responsible about this thing. This system has been widely implemented in US domestic operations and has proven to be generally effective as an evaluation tool. I'm giving you a notice. You can refer to the master thesis of your prof, Adil Taha Faid. It was a responsibility accounting in the year 1982, and this thesis is in the faculty's library to know how to use responsibility accounting in controlling and evaluating performance. It was applied in Besco Masr company. Now, evaluating managers in their local currency is illogic. and an optimal matter, although somewhat impractical because the headquarter usually prefers information translated to the parent currency. So each subsidiary, I will evaluate the performance of its manager using its currency used, even though the mother company, the parent company, wants to look at the evaluation using the currency of the parent. Objective measures of performance such as profitability as return on investment may then be used effectively by headquarters to judge the subsidiary as an investment. Now, why we fulfill currency translation? Why we translate the currency regarding or with regard to performance evaluation? We will see now and explain two main examples to evaluate subsidiaries of an MNC, but we have to consider translation of the currency to be able to evaluate well. The accounting records and financial statements of a foreign subsidiary are generally maintained in the subsidiary's local currency. So as we said before, suppose that the mother company of the MNC is in USA. There is a subsidiary in Saudi Arabia, so it uses the rial, the Saudi rial. Another subsidiary in Egypt, it is using the Egyptian pound. A third one in England, it is using the sterling pound. The mother company uses the US dollar. So the accounting records of financial statements for in Egypt will be in Egyptian pound, in Saudi Arabia will be in Saudi rial, in England it will be in sterling pound, in the mother company will be in dollars. So the US parent company, for example, must be able to translate these foreign currencies, Egyptian pound, Saudi rial and sterling pound, regarding financial statements to US dollar terms. If a subsidiary operates in a country with a stable currency, an evaluation of the subsidiary's performance in either parent's currency or local currency should be meaningful. You know why? Because there is a stability in the value of the currency. As in Saudi Arabia, for example, it is known that $1 equals 3.75 or 76 Saudi riyal. But for some circumstances in Egypt, for example, the dollar was 3.45, became 5.60, raised to be 20 pounds, then come down again to be 15.80 approximately nowadays. Translation is necessary for any or all of the following reasons. So what are the reasons of translation? These are 5 reasons. The 5th is the main, from my own point of view. To communicate foreign subsidiary managers with the parent company's objectives in terms of parent company's currency. So, to communicate foreign subsidiary managers with the parent company's objectives in terms of parent company's currency, so we translate to the US dollar, for example, according to the example in the previous slide. To judge the foreign subsidiary's profitability and evaluate the performance of the subsidiary's managers, unless there is stability in the exchange rate in the subsidiary's country, but we have to translate. To evaluate capital budgeting decisions, as well as the return produced by the investment of the parent company currency. To determine the periodic gains realized or losses sustained by the currency of the parent company, resulting from movements in foreign exchange rates. That's why you are saying if there is stability, no problem. But there is no stability in the exchange rates all over the world. Number 5, and the most important reason, to consolidate foreign financial statements with domestic statements and present them to top management in a currency familiar to them, which we consider the mean. Now we are subject to the two examples where we will translate the currency to be able to evaluate or assess performance well, and we may find in the second example that we want to cancel one of the three subsidiaries. Which one shall we cancel? So there are many reasons or many measures that we shall use, but the percentage of return on investment may be the main factor affecting if we can keep this subsidiary or remove it. Example 1. For translating and preparing consolidated income statement for performance evaluation. Here the example presents that having the following income statements for the year ended December 31st, 2014, for the mother American company X and its two subsidiaries Y in Saudi Arabia and Z in Egypt, you are required to prepare the accumulated and consolidated income statement, knowing that $1 equal 3.75 Saudi Riyal and equal 5.9 Egyptian pound. Values are in thousand. The income statement for the year ended is presented as you see. We have sales revenue minus COGS gives gross income. If we will deduct other expenses, we will get net income before taxes that we are calling operating income. If deducting income taxes, and it is at the ratio of 20%, so net income appear as you see. But in X, the parent company, values are in dollars. In Saudi Arabia, values are in Riyal. In Egypt, values are in Egyptian pound. How can you consolidate this statement? Shall I add $6,000 sales plus 7,500 Saudi Riyal sales plus 23,600 Egyptian pound sales to have the gross sales of the three companies? I mean X and its two subsidiaries. I think it is not logic to add different currencies because the total will be meaningless. So I have to translate all of them to be translated to Egyptian pound, to Saudi Riyal, or to the parent's currency, So I have to translate the Saudi Riyal to dollar, the Egyptian pound to dollar. As the dollar equal 3.75, so all the items in Y's subsidiary should be divided by 3.75 to get the values in dollars. Also regarding Z in Egypt, all the values are in Egyptian pounds. So we have to divide 5.9, that is the value of the dollar, to translate it to dollars. Then after this we can add all sales, all COGS, all and so on. How? Like accumulated and consolidated income statement for the year ended December 31st, 2014. Values are in $1,000. X is just the same as in the example, but all the values of Y in the previous slide, all the values in Z, column Z in the previous slide, are divided by the value of dollar or the exchange rate of dollar regarding the Saudian Riyal and the Egyptian pound to convert them to dollars. Now sales revenue can be added. Why? Subsidiaries, because and we may take example to the parent company to finish now our lecture today. Which income statement as that should be used if we to rank the three companies for performance evaluation and why? Shall we clarify the role of currency translation in evaluating the branch's performance of the mother company in the different countries? After translation, XYZ is an American company. Before translation, it is a multinational. Before its mother company is in the USA. The Riyal. It has three subsidiaries or branches in England. Case A, different currencies.
Notice that
are
England,
used.
sterling pound.
The previous
KSA,
one can
Saudi
be
riyal.
used because
Egypt,
all
Egyptian
are
pound.
translated
Notice
to dollar.
that
That's
$1
why
equal
the translated
5.795
one is the suitable where
Egyptian pound
one currency is
equal
used in the three statements.
0.653
So now,
sterling
ranking the
pound
three companies
equal
using the sales profitability criterion,
3.76
Z is
Saudi
the
riyal.
first at that date.
The
Because
following represents
profitability of
the
the income
30%
statement
of the company itself.
X is the
And
second
its branches.
because its preferred
And you are
profitability is
required to
20%.
prepare the
And Y
translated
is the
income
third
statements
because its
and the
profitability
consolidated
equal
one
12%.
for the year ended December 1st, 2014.
Just as we did in example 1. Then
Determine which branch we shall decide to stop
its activity
if we intend to keep two only, using the return on sales as
a criterion.
USA, it is in dollar. England, it is in sterling pound. KSA, it is using the Saudi riyal. In Egypt, it is using the Egyptian pound. So all the items in the first column of USA will be divided by 1.
So the result is the same.
But if dividing all the items, sales revenue, COGS, gross income, and the other items of the income statement in England by 0.653, it will be translated to dollars. If we will divide the items of Saudi Arabia by 3.76, it will be translated to dollars. The same if we will divide by 5.795 in Egypt, it will be in dollars. That's why if you look to the profitability of sales regarding the USA, you find it here 22.616%. It will remain the same after translation, but we didn't get this percentage here because the currencies are different. That's why
in this slide,
the translated, accumulated, and consolidated income statement for the year ended December 31st values are in dollar. The first column is the same, and the profitability of sales is 22.616% as it was. But in England, the values now are in dollars. In KSA the same, in Egypt the same. The consolidated we can add USA plus England plus KSA plus Egypt, COGS the same, all the items. Why? Because all now are in dollars. What about the percentage of the three subsidiaries? I have the best is Egypt, 16.393%. The second one is England, the subsidiary in England, 12.698%. The last one is the subsidiary in USA, 11.854%. This means that if we want to stop activity, we will stop activity of KSA. Look now. Now it is clear that we have to stop the activity of the branch in KSA because its profitability is the less. An important notice. Consider this well. I might ask you in your exam. Suppose that the income tax percentage that was 20% in all branches and the company itself, the mother company itself. Suppose that this percentage became 30% and 10% in England and KSA, respectively. Does the decision differ in the previous example? Yes. Why? If we will calculate the income tax according to the same percentage, 20% in USA mother company and in Egypt, but in England and KSA, the percentages became 30% and 10%, it differs. Why? Because profitability, if you will calculate it, will be 17.86% and 20.35% for England and KSA respectively. And this means that we have to stop activity of England subsidiary instead of Saudi Arabia. So tax rate affects, or tax rates affect the decision regarding the choice according to return on investment criteria or here return on sales criteria. Now, I can say that we finished the last lecture. I hope to meet you before the exam in our class to explain any difficult points in all the voice lectures I made to you. Be sure that the exam will be attainable for all of you for these circumstances, but please study well all the lectures I'm explaining to you to be able to get a very good grade, inshallah. Thank you. See you.